Yo, Matt, thanks so much for taking out the time today. I know we got some short time, and
Yeah,
we'll get
yeah.
you we'll get you back on the episode. But for one, I appreciate you coming on.
I'm working on cloning myself, Peter. But until then, I'll just gonna have to be. I'm just more busy than I should be. But grateful to be here, and thanks for having me on the show.
Yeah, man. Yeah, I appreciate it. And once you find that clone, I'll probably do the same thing. So,
Yeah, once I find the service,
yeah.
I can't seem to find anybody that does it. But once I do, I'll let you know.
Well, with AI, man, we're probably pretty
Never
close.
know, right?
Yeah.
It'll be there in the future, right?
Yeah, yeah.
Yeah.
Well, I want to get your take on the commercial side. I do residential. That's, my main bread and butter, but I want to get your thoughts on commercial space. That's, what you've done and for years, and see what your take is of the market, and where we're going in the next 12 to 18 months.
Yeah, yeah. Well, okay. So I'm not. What my company invests primarily in multifamily. We've looked at other stuff. We've looked at warehouse. We've looked at flex industrial. I'm passive investing in a few of those kinds of things, but I'm not an operator in those worlds. But I have seen, as you have, and maybe your audience has too, the tea leaves of the changes that are coming down the pipe in retail and office. And that's like the articles you read about the 1.5 trillion in debt that's coming due on bridge loans in that world. And there is multifamily debt coming due, not as much as in those worlds, but there certainly was a lot of multifamily that was bought over the last couple of years that was bought on these bridge loan deals. Which, let's start there. What a bridge
Yeah.
loan is think of like a bridge, right? What does it do? Well, it takes you from one place to another, right? It crosses a place you don't want to go and puts you to another safe harbor, right? So a bridge loan takes you from a current status of a property and gives you typically purchase and renovation dollars, so acquisition and construction to renovate a property. So you go and you can renovate the units, do the exteriors, the interiors. Hopefully, if you do your work right, you generate more revenue as you do this. You can increase rents or decrease expenses, or hopefully a little bit of both. You do all that, and the property's worth a lot more than it was when you bought it. Buy it for 10 million, you invest 2 million into it, and magically it's worth 16 million when you're done, right? So then you
Yeah.
refinance it over to agency debt. And that's been the equation for years. And that's what almost everybody did. We did it too.
Yeah.
And a lot of the big talking heads, big operators were using bridge debt as well.
Okay.
The problem with bridge debt is that it is linked to floating rate, meaning like the rate changes like every day. And for years, my rate changes. Well, so what? It goes from 3.8 to 3.9 or 3.9 to 3.95, right?
Yeah.
Rates have stayed down for years and years and years and years. And we've kind of become used to that. We've not been in an environment where rates change from a volatile fashion for years, but they have now. And so the interest rate that on many properties that were in there at 4% are now at like 8.5, 9, 10, whatever. And these are large loans. These are, multi-million dollar 2 comma, loans, right? Where
Yeah.
these monthly payments could go from 40K a month up to 85, 90, 100K a month.
Hmm.
In that. So I'll pause there, but that's what's happened in the world. And so that's caused a lot of these multifamily properties that were cash flowing or that were performing well or that were midstream renovation all of a sudden to be overnight almost to be not performing well enough financially, to the point where they either need to get sold or straight up owners are handing the keys back in. That's happening in a lot of places in multifamily right now.
Yeah, I mean, so I've had a lot of syndicators come on. So
Mm-hmm.
syndication, group of people coming
Sure.
in, and this
Sure.
person's, grouping up those people, finding the deal and stuff like that. So I've heard, I haven't spoken. I spoke to one guy in GoBundance probably like 6 months ago that a deal fell apart, and they were syndicate, it was a syndication. What have you heard on that end? Have a lot of people kind of just said, hey, I've been in it for 7 years, 6 years. I really have never seen like a market change like this. And no one has, obviously, with how increased the rates have gotten
Yeah.
over a short, period of time. But talk to me about that.
If you've been in for 6, 7 years, you haven't, because it's been heyday for the last
Yeah.
6, 7 years, right? I've been in operating for 18 years.
Okay.
So I was around 2006, 2007. So I saw the market change overnight. So I know that that real estate markets can do that, because they did
Mhm.
do that when I was investing originally. I mean, properties were worth, at that time I was investing in single family homes. So single family home worth 150K one day was, worth 50K the next day,
Yeah.
right?
Yeah.
Or less, right?
Yeah.
And then that's just all through changes in the debt market. Same thing that's happening now. So it has changed overnight, and that's due to the interest rates that have changed. It's also due to the volatility. Not to get too complex, but there's this thing called a rate cap that anybody has to buy when you buy a multifamily deal that's on floating rate debt. And that what that is, it's like an insurance policy that prevents your interest rate from going from 4 to 9 overnight, right?
Mhm.
So in essence is what it sounds like. It caps your rate. It's like, yes, rates effectively in the market are 9, but you, Mr. or Mrs. Investor, only have to pay a 6% interest rate, because it's an insurance policy. It ensures your rate can go no higher but from this number.
Yeah.
And for years, rate caps have been just a line item on your closing sheet. You even think about it. Oh, okay, 10 grand for a rate cap, no problem. Because interest rates have gotten so volatile, rate caps have gotten crazy expensive.
Yeah.
We bought one property where we bought a rate cap for $32,000. We
Okay.
refinanced that property. I mean, and so that rate cap was still active. It was still, that insurance policy still had more time on it, right? We
Mhm.
were able to resell that same rate cap that I paid 32 grand for. I was able to resell it to somebody else for $250,000, right? So the same, same interest rate,
Yeah.
same rate, same everything, same debt burden, same strike, all of it. So that's how much rate caps have gone up. And so owners that are being asked to, or forced, let's say, to buy new rate caps by their banks, that had in their budget a rate cap costing them 15, 20, 30K, are now
Mhm.
finding out that rate cap that they need that their bank is requiring them to buy may cost north of $500,000. This
Wow.
real story,
Yeah.
may cost that. And so that's what's causing some of these owners to either turn their keys back in or fold up. You read about the guy that lost 3,200 units in Houston,
Mhm.
right? That was a rate cap issue, as I understand from reading the tea leaves and what happened. So, yeah, you're just having the debt terms change very quickly. To
Yeah.
shorten it up, Peter, that's what's happening, and that's going to cause more and more properties are going to be sold. It's just beginning, but we as a company at DeRosa Group, sitting here talking to you on September 7th of 2023, we're seeing more and more properties come online that are legitimately distressed, that need to sell. There is a gun to the seller's head. They have to sell or they will lose their property, and have to they either sell and get what they can, or hand the keys back to the bank.
Are you guys actively buying stuff like that now, or are you guys waiting to see where the dust settles? Because obviously, what you just talked about, we
Yeah.
don't know where it's going from here.
We're,
The next
we're not
18 months.
bullish. We're not like bearish. I don't think the market's going to get cut in half.
Yeah.
The problem we're having, Peter, is we are getting deals that are showing up that are straight up distressed deals, but the deals unfortunately still don't pencil for what the seller's asking, because
Yeah.
of the increasing cost of debt, because of our either trying to sell these properties at, multifamilies evaluated on a cap rate, right? So cap rates are still too far down. They're still like 5.5, 6, and my debt cost me that much. Six,
Yeah.
6.5, right? So just there's too much disparity, not enough yield spread in the market yet. There will be, though.
Yeah.
We've underwritten a few of these deals, but we found that the property's worth less than what they owe, on
Mm.
our numbers anyway. And these are people trying to sell for less than they bought it for like a year or two ago. I mean, we had one deal where the guy paid, X amount of dollars for it a year ago, 1 year ago, and he's trying
Yeah.
to sell it for 90% of what he paid for it, and it's worth 75% of what he paid for it, because of the changes in the market, right? So I think there's more shakeout that needs to happen. I'm not a blood in the streets predictor.
Yeah.
That's not what my crystal ball is telling me, but But I could be wrong. But I don't believe there's going to be blood in the streets because there's too much fixed rate debt out there. There's too many people
Hmm.
that are in good, solid positions with plenty of cash reserves that went in with low interest rate debt. That have plenty of LTV in there, so they need to refinance. They can, and they'll live, and that's there's plenty of those. But for every like at every say 30 or 40 people that are in good shape, there's 5 to 10 that are in really bad shape that are going to need to sell. So I think that you're going to see more and more of these distress sales come on.
Yep. Yeah. No, I think so too. I think it's going to be, like you said, I'm not this, hey, it's going to be a super terrible market for the
Mm-mm.
next 24 months. I think that
No.
there's a percentage of people, probably 10 to 15% where they're going to lose the property. They're going to, bounce out, and then they're going to either find their groove back into real estate or they're going to exit completely.
Yeah. These are like
So
overnight syndicators that I'm seeing that are like the folks that we are seeing that are selling out. We have one company that went from 1,000 doors under management to 10,000 doors under management in a 1.5 year period. Right.
wow.
So they just got over their skis. They scaled too fast. Now they're trying to unload some stuff. Another property that we saw, it was a group of full-time medical doctors that pulled their money together and syndicated it too, got some of their other friends in and
Hmm.
had full-time jobs
Yeah.
and bought a multifamily property. And they're, just weren't really equipped to operate it, didn't have the right ops team, thought that you would kind of just buy real estate and make money kind of thing. And they're selling too. So I think that you've got folks like that either scaled too fast or should have just stuck to passive investing and not gotten into the operation side. I think those are the folks you're going to see, or that
Yeah.
maybe took like one guru weekend class on
Yeah.
multifamily investing and decided to go and buy a couple thousand units. Those folks are going to be the ones that are going to be selling also. But the people that are willing to play the long game, I think there's going to be opportunities. The worst thing you could do is overpay right now, though.
Yes. Yeah. Overpay. I mean, like any realm of real estate, commercial to residential, you got to make sure that the numbers work out and put a
Yeah.
buffer in that's, where it's at. Like if it's, someone's trying to, like you talked about, it should be at 75% instead of the 90% that they're trying to sell. No, let's, instead of that 75, let's go, 70 just to be, sure and buffer it
Mhm.
out, especially if you're newer and you're not as seasoned as you are.
Yep.
Let's just make sure there's a little cushion in there.
Mhm.
And I think too, like even in these times and in good times, people just aren't as patient and they're like, I can't get a deal, I'm out.
Yeah.
But in these, like you got to make sure, or they get into a scenario where they do buy something and they think they have enough buffer and they don't, and then they get stuck with the property or they have to, give it back to the bank. Those are challenges. Those are, the things where people are getting out of the business. So going back, being in 18 years in the business,
Mhm.
seeing what you saw in 08, 9, 10, 11, I wasn't in the business then,
Hmm.
and then seeing what it is now.
Yeah.
Um, Granted, obviously it's different because it's a rate thing versus,
Mhm.
then was just, a banking default thing. But are there any similarities that you've seen now?
No.
None, none. Completely different.
History repeats itself, but it also like doesn't exactly.
Yes.
It kind of repeats itself with an accent kind of thing, right? So it's not exactly like it was. Last time it was you just could not get a loan. I mean,
Yeah.
banks absolutely shut their doors, said, okay, the folks that lend us money, Wall Street, and like those guys, they've shut their doors, and so we're going to close ours as well and not lend any more money out or whatever. So banks got super skittish. And when you were trying to do a deal, you couldn't get a deal done. I mean, and here's the other thing, right? People wait for real estate investing to get easy, right?
Hmm.
Real estate investing has never been easy. This is a
No.
full contact, very difficult sport, not cut out for everyone. Only sounds easy when you read books about how much money people are making and stuff like that, right?
Yes.
Yeah. So by far, it's not an easy sport, and it will always be difficult in some form or fashion. Before then, it was hard to get in like 2006, 2007. It's hard to get deals. Everything was getting overbought,
Hmm.
getting bid up and up and up and up. Then after 2007, after the crash, it was very hard to get financing. There were deals left and right, but if you didn't know how to raise capital, the bank was not going to lend you on good deals. Banks were going in super skittish on LTVs. And they only got warmed back up to go back in like 2010, 11, 12, right? So it was really weird for a while. Real estate investing now is weird as well, and it's different and it's hard because the disparity between what people are asking and what properties are worth is a major delta there. So it's
Yes.
hard to find deals that pencil. So you either scratching your head being like, okay, well, do I just say screw it and overpay for the property so I can get into the game? Or do I wait, air quote, wait for the market to come down and just kind of sit in the waiting place and wait for things to change, wait for things I can't control to happen, like the market changing, right?
Yeah.
Or do I get creative, and what does that mean? So I think that what we're seeing now is no different than any time else. You got to just kind of like find the hack for the market that works for you.
Hmm.
And for us, that is work. What we're doing now is working with banks direct. We are trying to get a hold of owners direct. We're trying to get around the people that don't realize it, but they're absolutely slowing the market down, which are brokers.
Hmm.
No offense. I think you're an agent too. So
Yeah, I'm an agent, but yeah,
sorry, but
yeah,
you're a good
you're
one.
okay.
Yeah, you're an okay one. All right,
Yeah,
we'll
thank
let
you.
you live though.
All right,
But a
all
lot
right.
of brokers are actually slowing the market down by not allowing the buyer and seller to get a lot more creative to make the transaction happen.
Really?
And yeah, I think that's what's going to open things up, because the broker's so skittish about losing their commission and
Hmm.
about the deal blowing up. But we need more seller financing. We need more equity restructure.
Hmm.
We need to allow a buyer to contact the seller's bank direct and do a workout or do a short sale or do something like that. But just the brokers are kind of traffic copping more than they should be in multifamily. And I think that's going to slow deals down as this thing continues to grind more to a halt.
Yeah, I mean, you're absolutely right. I mean, but if you look at it, unless I'm wrong here, multifamily or commercial, if there's seller financing, are the brokers cut out completely? I
Mm-mm.
mean, no. Yeah. So like, if
They
you
don't
look
really
at,
they don't see that though. Like they don't
yeah,
see that as like as clean of a sale and as reliable of a closing. That a seller finance deal is maybe more likely to close now, or a deal that's creative financing, than a agency backed good old fashioned bridge. I mean, certainly not bridge. I mean, bridge
hmm,
loans used to be 3 to 4%. Now we're getting quotes at 11, 12%, right? Like hard money rates.
yeah,
So what's the odds of that closing? You
yeah,
know, versus like getting creative with the seller and working something out with, yes, some equity across the table, not just buying it for a handshake and a smile, but like buying the property with real equity crossing the table. And from that cash and equity, there is this lovely thing called a commission that the broker gets paid on that
yeah,
can get peeled out of there. We've tried to get brokers to listen to us, like, oh, and they blame it on the seller. Nah, the seller wants to keep it clean. Seller's looking for a nice and easy transaction. No, they're not. They want to sell. That's
yeah. They
what
want to
you
get out of
want.
it. Yeah,
Like the seller wants to make money and to not go bankrupt. That's what they want, right?
yeah.
Um, yeah, good.
I think that point is the same thing for on the other end of residential for agents that don't know or don't want to know anything about wholesaling. So,
Yes.
that like you talk to an agent, and they're like, yeah, what's wholesaling? If they're, not investor friendly or anything like that, and they have no idea about it, or, they just don't want to think about the idea of it
How
because,
many agents have you heard to say that wholesaling is illegal? You know,
yeah, no,
like,
I
oh,
know.
it's not legal. It's not, by the Department of Banking and Insurance, or the Real Estate Commission doesn't sanction wholesale. Come on now. It's been
Yeah,
around forever. Okay.
yeah,
And that, but yeah, that's yet again an example on how I had again, this is like dating myself, Peter,
yeah,
but back in the day, when there was this thing called short sales, which you're going to see again. You're
yeah.
going to see short sales come back. But there were people that made a living short selling. And what it is like, party A wants to sell, party B wants to buy. So party B gets party A's permission to talk to their bank and get the bank to sell the property short of what the debt on the property is, right?
Hmm.
So the bank's willing to take a haircut. Well, guess what? The bank is insured. Okay.
Yeah,
They'll be just fine. Don't you cry a tear for the bank.
yeah,
They're good. So these banks sell the properties for less than what's owed on them so that the transaction can happen. Because guess what? The bank doesn't want the property back. They
yeah.
don't want the real estate. They want as much money as they can get so they can get back out to cutting more loans.
Yes.
So We were doing that back in the day. We did a lot of short sales. And I can't tell you how many agents, would, sellers asking $400,000, properties clearly worth 300,000, and you could tell they're not making their payments. You can kind of tell, for a single family or for a small multi, when the seller's out of gas, and that. So we would just go to the agent and say, hey, listen, looks like this property is not worth anywhere near what the seller's asking. And my guess is the reason they're asking this is because that's the number that gets them out from under their debt, right? And the agent would admit to that. Yeah, it's what they owe. Okay, got it. Well, what if I could make what they owe less? And the agent just doesn't get it. And, well, no, it doesn't work. Can't do it. You can't do that. You can't talk to their bank. The bank's not going to take a haircut.
Yeah.
Yeah. Anyway,
you're like, the bank just if they can't get all the money back, they want as much as they can back, really, at the end of the day.
It.
So, and that
they want
was
to be liquid. They want that liquidity because they can lend it out at 3 to 5 times on the dollar,
Yes.
So,
yeah. I mean, that was when we got on the call. I was talking about that deal. Like, I was trying to talk to the bank. I'm like, hey, the seller gets paid and then you guys get paid. You don't have to go through this whole trustee sale and everything else. So, and go through this whole foreclosure, you guys can have it clean and done before it. And granted, the people working at the lower level didn't really understand that, but it's like, I'm helping you to help out, your position, and we need to get this done. So yeah, it's one of those.
There's going to be more of it. And folks like yourself that have gotten good at it and flexed your muscles at it. Those people were gold back in the day. The short sellers that were out there doing deals, and they would find realtors that got it, and those realtors became the biggest funnel ever of leads for those short sellers. And then eventually what happened was, this is kind of how it goes, right? Pioneers get in there and make some money and figure it out until everybody sees what they've done. And then the gold rush happens, right? So back then what happened was law firms and title companies got wind of these short sellers that were in there negotiating with banks, and they started broadcasting that they could do that too. And so for a flat fee, they were negotiating short sales left and right. And so the short seller businesses, the entrepreneurs that were doing it, ended up losing out on a lot of the leads, and law firms and title companies started figuring out how to contact banks direct and say, okay, listen, bank, I know you're owed $500,000, but here's 30 comps that show me that you're now worth 300,000. So what do you want to do? Right. And once the banks, again, they're very pragmatic. They got committees, and they got loss and mitigation departments and everything like that. They're very willing to take the haircut, move on, give my money back, So I think that's what we're going to see more of in the future, Peter, is let's just call all that creativity, right? And creatively ways to work out deals. I got one more thing that's become the gold standard. It's like the golden egg of real estate, And I got to give a shout out to my buddy Pace Morby on this one. It's buying property subject to the existing mortgage. And that sub 2 does not only have to happen in single family, which is what he does a lot of. Sub 2 happens in the multifamily world. We're looking at a deal right now today that has a 3.2% interest rate mortgage on it. Think about that. What's that worth? You know, right? So we can buy the property and assume that debt. There's going to be you're going to see a lot more of that, of people wanting to buy properties, assuming the existing debt, which happens a lot in commercial. It doesn't happen as much in single families. I'm sure Pace has to educate his sellers on how this thing's going to work. But on the larger side, it's very common, believe it or not. We've done it multiple times already.
Well, and I think, just like I've had multiple conversations with my team, if you look at, so if we go back to residential real quick, just because that's my wheelhouse, there's been 29% of realtors that have let's go activity, buyers and sellers have dropped off because interest rates, affordability, everything else. And that being said, like, we're going to continue to see that. You just got to, like your point, you got to be more creative. You got to go out there and do, if you want to go traditional, got to do open houses, got to do door knocking, got to, be in front of people, do meetups, everything else. If you're on the investor side, you got to door knock, you got to mail, you got to do all this other stuff that you may have not done before, because it's been really good for the last 2 years.
Well, the other side of it was like making deals work, right? Again, that was the hard part, right? The hard part was getting the deal.
Yeah.
Becoming the winning bid out of a noise of like 25 bidders on a property. In my world of multifamily, that was common. Like, you try to wave your hair in the air, screaming, yell real loud, try not to overpay too much. But you knew things were going up, so you wanted to get in, right?
Yeah.
That was the game. That was the hard part, was becoming the winning bidder and getting the broker to give you a look at the deal. And they were like the belle of the ball. Like they were like the prom king and queen, these brokers, because they would get a deal and they'd have investors clamoring over them to get to that opportunity.
Yeah.
And all the deals worked, right, financially, because debt was so low, and everything worked out. There was so much equity running into the streets to get into multifamily. It was, once you had a deal, easy. The other side of it was easy once you had the deal. The hard part now is finding deals that even come anywhere close to pencil. So it's exactly what you said. The same equation works on the small side, on the big stuff too. So yeah, it's letters. It is reach outs. It is one thing we haven't talked about that I want to just throw out there as a tip to anybody listening, even for smaller, big real estate. Those that are going to be successful in the next couple of years in real estate, in any size real estate, are those that are going to become market experts, right?
Yeah.
So if your market is like, San Diego, California, whatever it is, for us, it's like the Piedmont Triad of North Carolina. We are experts on the Piedmont Triad of North Carolina, and we know all the brokers there. We're very well connected in that market with contractors and brokers and property managers and whatnot. I'm not saying that to pound my chest. I'm using it as an example on what your listeners should be doing on picking not multiple, a market, one, and becoming an absolute expert there. And so when a good deal comes up, you're the market expert that the broker is going to call. When a good deal goes into foreclosure, you're going to know about it because you're super uber focused on that market. Those that are trying to cast the net into 10, 15 markets in the United States and waiting on good deals to show up, forget it. You're not going to get the phone call. I'm going to get the phone call because I'm focused on a market, not 30, right?
Yeah, no, very true. I mean, you got to be hyper focused. It's one of those, a sniper versus, like buckshot. You got to really hone in on where you're going and be very focused and clear on how to get that deal and what you're going to do. Well, I know we're short on time, so we'll get you back on the podcast, but
Love to.
I think, I think this is a good discussion, especially now as we go into the fall of 2023, going into 2024. 2024 is going to be very, very interesting on what happens with the interest rates, where we're going to go with it, and in the election too, so I think there's going to be a lot
going to
of
be a fun 2024 with the election, with rates, and with further changes in the economy with regards to, who knows where the other shoe is going to drop is and everything like that. So all I can say is put your seatbelt on and be prepared to pivot for changes, right?
Yeah, no doubt. No doubt. Well, hey, Matt, where can people find out more about you?
Sure. Company website's the best way, DeRosaGroup.com, DEROSA, DeRosaGroup.com. They can hear about education products that we have. They can hear about passive investment vehicles we have to offer. They can pick up a copy of my book, Raising Private Capital, at that website. So DeRosa, DEROSA, Group, GROUP.com.
Perfect, man. I appreciate your time, Damon.
Thanks, brother.
Hi, Matt.